Hello, fellow rebel capitalists. Hope you're well. So, in the news today, the stock market is on fire, up 500, maybe 600 points. But the reason it's up is very interesting, which goes to prove the point I was making yesterday on a video that the stock market is now not a reflection. In fact, it's not even close to a reflection of the overall economy or the businesses, the corporations within the economy. It is simply a casino that gambles. And instead of playing a slot machine or spinning a roulette wheel, what everyone in the casino is gambling on is what the Fed will do with interest rates. That's literally the only thing that drives the market. And well, I shouldn't say the only thing, but you guys know what I'm talking about. That is definitely the strongest cross current. We'll just say that. So let's get into this story from Zero Hedge, and you guys will see what I'm referring to. So the title: Bonds, Stocks, and Gold soar on weaker wage growth. You heard right. Stocks soar on weaker wage growth. If aliens came down from space or Mars or whatever, and you asked them, if we had weaker wage growth, do you think that would make the stock market go up or down? If we had better economic metrics coming out, do you think that would make the stock market go up or down? And obviously they would say, well, the better the numbers, you would assume the better the stock market would be, the higher it would go. Oh, no, no, no. You would be completely wrong. It is the exact opposite of that. So the article says, forget the good news in the jobs report. That was yesterday. Record unemployment and underemployment rates. Let's focus on weakness in wage growth. So a bunch of revisions came out today. And this guy, Nick Timiraos, who a lot of people say is basically the mouthpiece for the Federal Reserve. If they want to get something out in the media, they kind of leak it to this guy. I think he works for the Wall Street Journal. He says revisions to average hourly earnings data paint a marginally less worrisome picture for the Fed. Okay. What type of picture does that paint for the real economy, Nick? Gee, what? And I'm not throwing him under the bus here, but I mean, what type of picture does that paint for the average Joe and Jane that are just struggling to put food on the table and a roof over their head? So for the Fed, I guess it's less worrisome than the wages on the November report. The upturn in wage growth in November, originally reported at a plus 0.6, today was revised down to a 0.4. And annual wage growth in December was the lowest since August of 2021 at 4.6. And again, let's keep in mind that inflation, as of right now, what the government admits to, is right around 7%. So negative real wage growth. So the lower wages and the lower the wages are relative to inflation, well, obviously this is great news. And the stock market just rips higher as a result, as you would expect. So bond yields plunged as well. Let's actually go over to a story from CNBC to check out bond yields, because there's some other things here that I think are interesting and well worth going over. Hopefully I can get to the story. Well, if I can't, I'll summarize for you. Right now, the 10-year Treasury, and we can look at that very quickly, is at, oh my gosh, geez, I looked about an hour ago and it was 3.62. So now it's all the way down to 3.57. Keep in mind, guys, that's the 10-year Treasury. It was up just about a week ago, or a few days ago. It was up 5 days ago. Let's do 1 month. Yeah, it was up almost 3.9. And just in the last couple days, it's just plummeted from 3.87 down to 3.57, 30 basis points within the matter of, geez, 2 or 3 trading days. That's a big move on the 10-year treasury. So this now it's the yield curve. I don't know if it's steepening, but when you see the bonds, especially the 10-year, really start to go down at this rate, it means that inflation expectations are coming out of the market, which is most likely, again, why the stock market itself is ripping higher. And I would assume that within the stock market, if we look at the NASDAQ, that's probably up the highest. Let's take a look at that really quick. So Dow's up 1.69. Oh, no, actually, NASDAQ is only up 1.46. I would have assumed it was lower than that or higher. Another thing that I find interesting based on all this data that would suggest disinflation and the Fed maybe hitting the pause button sooner than the market expected based on the blowout jobs number we saw yesterday is Bitcoin. And Bitcoin is down today. So it seems like it's kind of depegging. And I know one day doesn't make a trend, but it seems like it might be depegging from risk assets such as the NASDAQ. In one way, I think that's a good thing. In another way, it could be a bad thing if you're betting on Bitcoin ripping higher as a result of the Fed pausing or pivoting. And I think it's interesting that gold is doing the exact opposite. So gold is doing what you would expect, and Bitcoin isn't. Nothing against Bitcoin; it's just an observation. But the biggest observation is that bad news is good news. Stocks rip higher, and the bond yields, especially the 10-year or last few trading days, have plummeted, even in the face of the quote unquote strong jobs report that we saw yesterday. And today we're getting some revisions from past data, which is further accentuating the point of potential disinflation. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. For those of you who don't know, we've got our own store now. We got the Rebel Capitalist merch store. So if you want to get yourself an End the Fed hat like this, you can actually get a black one as well. The black ones look pretty cool. I think I might buy one. And you can get the adjustable or one size fits all. And then you can get these Rebel Capitalist t-shirts if you'd like. You can just go to our new merch store, which is rebelcapitaliststore.com. All right, guys, enjoy the rest of your afternoon, and we will see you on the next video.